Welcome to the 2022 Economic Preparation and Depression Channel. I'm your host, Tony. Thank you for joining me on this Sunday, August 21st, 2022. Today, we're going to be talking about briefly the jobless claims. Last week's jobless claims were down, but still good news, but still elevated, much elevated, with continuing claims continuing to rise. We're going to be talking about energy bills as well. They're going up: gas, lighting, utilities. Even though the decrease in gas has come down maybe 4 or 5 cents on the average, according to AAA.com, the last 2 months, we're still fighting inflation on energy, transportation, utilities, on all other fronts. Insurance bills as well, homeowner insurance bills as well. So, and also we're going to briefly talk about Chairman Powell, Federal Reserve Chairman Powell, his meeting at Jackson Hole, Wyoming this week on Wednesday. They're going to be talking about the economy, and they're going to be talking about next month's rate hike. September, there's still rate hikes on the table, anywhere from 50 basis points to 75 basis points. Remember, we're still in the rate hike season as far as interest rate hikes, and that is trying to slow and with two-prong injection to slow the economy down and also to slow the rate of inflation. But either one of those is going to be a struggle. So we're going to continue to see high prices in food, utilities, transportation, and other costs. And so we're going to get right into it. Please be sure to subscribe to Preach to Me for the latest financial news in the United States. I really appreciate you guys' support. I read everyone's comments, and I thank you very much. So let's get right into it, guys. Right now, ladies and gentlemen, jobless claims, according to CNBC.com, this was last week, Thursday, urged lower as Fed looks to cool labor market. So the way that they spin it is that the jobless claims are 250,000, right? It's down 2,000 from the previous week and below the 260,000 estimate. So we're still losing jobs, but just at a lesser. We're still having more people unemployed, but just at a lesser clip. So I guess that is good news. But we still have continuing claims, okay, which is increasing by a number of 7,000. So what that means is that those who are unemployed are staying on the market longer, even though there's a lot of now hiring signs. You guys seen these on these school buses now hiring, and the fast food now hiring, and the retail. You've seen these signs at Walmart, $14, $15, $16 an hour apparently. All of these signs are out there, but what they're not telling you is that a lot of these people are quitting because they're not getting 40-hour work weeks. They're not getting the 40-hour work week. The traditional 40-hour work week is starting to become the way of the dinosaur, at least for lower paying jobs. You know that you work these jobs in retail and hospitality, and these service sector jobs, they give you 32 hours a week or less to keep from paying you full-time benefits. And that's the problem. That is the elephant in the room that nobody wants to talk about, is that yes, there is work available for millennials, younger, even Generation Y students and high school students, 16 years old and up. The problem is that they're saying, the kids are telling us that they're not making enough money to make ends meet. To take the gas, it's not even worth it to go there because, if you're getting $14, $15 an hour, but you're only getting 25 hours, 20 hours a week, well, you're back to where you started. Now, something is better than nothing. Granted, you should definitely take that. But it definitely takes its toll when the gas to get there per week, if you're driving every day and you have to commute 30 minutes or more to work, it's taking its toll on your budget when you're trying to make a living. Even if you're living with someone, roommates, you still need money to survive and to pay other bills like your cell phone, your car payment, insurance, whatever other bills you may have, credit cards. So this is what people are saying, and that's the big elephant in the room. So the bad news is that the continuing claims of jobs are still increasing at a rate that's not really sufficient for growth, for a healthy economy in America. The good news is that there is jobs still available. There's still now hiring signs. Like I said, even in the white collar jobs, people are shifting around white collar jobs. Families are moving to more lower costs, to getting out of New York City, getting out of the DCs, getting out of the San Francisco's, Dallas, Texas, the expensive cost of living places, and moving into small to mid tier cities in order to save money, in an attempt to save money. And so this is what we're looking at, guys. And so now we have this policy bill here, energy bills continuing to be squeezed as UK costs soar. So I don't want to leave out my European friends as well in the EU. Whether you're in Romania, UK, France, Spain, costs over there are rising, and inflation in UK peaked at 10.1%, another 40-year high. We're at 9.5%. We'll be at 10% by the end of this month here, guaranteed. At least the official numbers. The unofficial numbers, according to shadowstats.com, already has us at 20% inflation, as you and I know. So Expect your gas, the heating bills to go up as we head toward the fall and the winter. Expect your regular air conditioning bills, consumption bills to go up in terms of your light bill, consumption bills going up. Look at the other bills that are going up here as well. Now, one thing is not going up, and all of these, and this is worldwide, this is salaries. The salaries are not increasing. Production is not increasing in London, France, Spain, Romania, Czech, Germany, United States, Canada, but everything else is increasing. So if your salary is not increasing, but your bills and your cost of living is increasing, that's a bad sign. That's not a good sign of a healthy economy, as you know. And most of the analysts here, this Vanguard economist, he warns that quote, the worst of the UK inflation is yet to come. Well, tell us something that we don't know. Remember, when the U.S. is a $15 trillion economy, it takes time for these things to come. So what that means is that you may print up money in the stimulus package. We've had 3-4 stimulus packages, not counting the money that we sent to Ukraine, over trillions of dollars that we sent to Ukraine, and it's still ongoing. Okay, it takes time for that money to funnel through this economy and to for the effects to be felt. So by next year, 2023, we expect to be in a severe recession. I expect to be in a severe recession, even though it's going to be painting the picture in the media that things are growing and everything, but we know that that's not the case. So here we go. Chairman Powell, he used to testify, he used to tell Jackson Hole, Wyoming, the financial, that recession won't, quote, stop the Fed's fight against high inflation. In other words, they're committed right now to raising rates above, they have to raise rates above the peak of inflation anyway if they're going to make real changes. So he is going to continue to raise rates, and that's going to continue to put this economy further and further behind the 8 ball, because right now what we have is we have an economy, we're raising rates into a slowing economy. And you never want to be doing that, because that's a bad sign. That means that layoffs are coming in some industries. Okay, so layoffs, you can expect layoffs. It depends. We don't know exactly where the layoffs may come, but most likely it could start with the white collar jobs first, from tech. It could start from tech, engineering firms, you name it. Whatever production problems we have here in the Western world, that's where it could start from. Or it could start from the bottom up. But this time, I think it's going to start from the top up, from the top down, meaning the high white collar paying jobs are going to be first to be cut. The non-essential jobs are going to be cut. Things like Social Security, veterans benefits, those things obviously are going to remain. There shouldn't be no worries with that. But there will be worries in these tech jobs and these marketing, banking jobs, finance sector. All that's going to be mortgage sector, housing. Those are the sectors that are going to have to worry about this going into next year, to 2023, because Chairman Powell is already committed to. Next Friday, he's going to be speaking at Jackson Hole, Wyoming. I tell you, with the meeting this coming Friday. So with the consumer price index running high, inflation's at 9%, their target's above 2%. That means that they're going to continue to raise these rates, 50 basis points at a time. When what they should really do is raise the rate one time, 1 full percentage point. Keep raising it 1 full percentage point until we get up to the rate of inflation, which is at 9% and growing, the official rate, quote unquote. They would have to raise rates to 12% or higher, like Paul Volcker did back in the 70s, but they can't do that because we have massive debt. We have a $31 trillion national debt. We have personal, consumer, and business debt at all-time highs. That's the problem. And so either way, it's going to be painful. But if I was the Fed, I would go ahead and raise these rates a full percentage point. Go ahead and get it out the way, because we have to get ahead of this storm before this thing is only going to be worse. The later you wait, the worse it's going to get. And that's why I preach preparedness on this channel. Continue to, whether you're picking up a second hustle or a second job from home or outside, continue to do that. Continue to stack, save 15 to 20% of your income after expenses and operating expenses and all of that. And try to invest in real tangible goods, because that's what's going to become a shortage of. What I mean by that: food, water, security, medicine, antibiotics, any medicine that you need, storage, generators. All these things are going to become absolutely crucial next year, by next summer, when we're not going to be able to see these items on the shelves at Home Depots and Lowe's and Save-A-Lots and True Value Hardware. They're going to either intentionally cut the supply of some of these things because of what's coming, and this is also going to cut back on crime, because you got to remember, crime is going up as well. As the economy gets worse, crime is going up, and not just the typical areas that people think of, Chicago and Baltimore and Detroit. Crime is going up in a lot of these mid-tier cities too as well, suburbs as well, and hinterland. Crime is going to go up everywhere, because people are going to realize, and be careful with your cars, where you park your cars at, and that thing too, guys. They're stealing catalytic converters. They're stealing. Before, it was airbags in some of these places. So we have to be very careful and vigilant of our surroundings as the economy gets worse, because crime is going to get worse, and there's not going to be enough police officers or law enforcement anywhere to handle the amount of surge of crime that's going to be coming into next year as we get more into this collapse that they're trying to hide. So be prepared, guys. Stay blessed. God is going to take care of us, but we have to be stewards, diligent stewards of what He's given us in terms of time, money, and resources that we do have to make a difference in our communities, in our families, and in the world. Okay, I'll talk to you very soon. Enjoy the rest of your Sunday. Bye bye.